Rule 1 workshops are the perfect opportunity to ask questions because not only do you have your coaches that you get to work one-on-one with, but you also have instructors and faculty who are going to be presenting information and also answering your questions. In fact, why don't we take a look at some of the questions that Phil has answered thus far this year?
On average, how many value investments do you put in historically per year? Okay, brand new ones. I would say probably 3 or 4, maybe on a big year, right? Not many. It's hard to find really good companies, and we wait patiently. We have quite a laundry list of companies, and we have a big year once in a while, like in 2009, where we can buy everything. We might buy 10 in that time period. But when the market crashed in 2020, I think we bought 4 at that point in time. We were hoping to buy more, but it turned around too quick for us. Not very many. Why do sometimes the 3 valuation methods wildly differ? What do you do when that happens? What I've found is the biggest wild difference happens because of growth rate. If you have a high growth rate for a company, it has a corresponding high multiple, a high PE ratio, and the result can be a lot higher valuation than you're getting from a 10 cap or a payback time that are dependent on free cash flow. And I tend to be a little bit conservative when I'm looking at that and use the margin of safety analysis, which will get me maybe a very high result, as a way of looking at what the potential value that company might be. What's the potential value? And I use the 10 cap and the payback time more as a target for where I want to be. And they're often pretty similar to each other. How do you get a stock that becomes a 10 bagger? What you do is you look for companies that have a high growth rate, high return on invested capital, and are massively on sale. And one of the ways that you get a 10 bagger that's a little bit more advanced from what we've shown you guys is that you just have to remember that when you're looking at a business, any business we're looking at, you're looking into the future, right? It's like you're driving a car, and if you look out the back window, you can see the road really well. If you look out the front window, it's just fog. It's all foggy in front. And that's really the reality. So if you're looking at a business that it's been around 10 years, it's got a really good track record, what you're looking for a 10 bagger is a company that is not only on sale, that is down 50% from what it's worth, but also has a growth rate that is probably in excess of 15% per year, in which case you buy it. And this is what happens all the time. We buy these companies on sale, which means they're half off. And then they go back up to where they were, back to their real value. And we've doubled our money. And often we've done that in a year or 2 years. So the rate of return is very, very high. But then the company, if it's a company, let's say like Tyson Foods or something, it's not going to grow very fast from that point on. So if you want something that's going to be a 10 bagger, you're going to need to buy a company that's not only on sale, but also has a very, very high growth rate, so that once it's back to intrinsic value, it's going to keep doubling your money every 4 or 5 years. That would be phenomenal. That's how I would do it. In other words, you have to be even more selective.
Now that you've had the opportunity to hear some of those questions, do you have any questions you want answered? Sign up for a workshop, show up, and let's get you going.